The US economy, what's next? Welcome back to our YouTube channel Shareholdr. In today's video, we are going to talk about the US economy. The US economy has come out of 2021 in acceleration, but growth combined with global supply chain constraints have pushed inflation higher than expected. Interest rate hikes were announced in March 2020, which are expected to cool the economy, but they still need to control inflation despite 2 more hikes. The Conference Board predicts that economic weakness will intensify and spread more widely across the US economy in the coming months, with a recession starting before the end of 2022. This outlook is associated with persistent inflation and an increasingly aggressive stance by the Confederation Reserve. We expect real GDP growth in 2022 to be 1.5% over the next year, and growth in 2023 to slow to 0%. While we don't believe the US economy went into recession earlier this year, mainly due to the extreme rigidity of the labor market, we do expect a widespread recession. We updated our forecast for the third quarter of 2022 from 0.3% to 0.5%, largely due to an upward revision of the previous quarter's GDP data and various indicators indicating a slight improvement in dynamics economic at the beginning of the quarter. However, these improvements will be short-lived as economic growth continues to cool now in the fourth quarter of 2022. Furthermore, reflecting a more aggressive outlook on interest rates from the Federal Reserve, we have further lowered our forecast for the fourth quarter of the year, 2022, and much of 2023. While consumption growth is likely not to drop below zero until the fourth quarter of 2022, we expect non-residential investment to retreat faster under the weight of higher interest rates. Residential investment will continue to contract as the housing market works to find a new lower equilibrium. The US economy at the start of 2022. The economy ended with 2021 with GDP growth of 6.9% in the fourth quarter. Along with growth came an increase in inflation, 7% year on year, well above the Fed's 2% target. The unemployment rate at the end of 2021 was just 3.9%, down from 6.4% on the beginning of the year. Unemployment peaked in the pandemic at 14.7% in April 2020 when the economy shut down. The Federal Reserve kept the federal funds rate near zero, and with the help of its historic mortgage and treasury bond purchases, interest rates on home loans, auto loans, and personal loans were at historic lows or close to them, which spurred economic growth. But at its December 2021 meeting, the board announced that it would reduce purchases of treasury and mortgage-backed securities at accelerated rates, an indicator that higher interest rates were on the way. On May 4th, the Federal Reserve raised rates by half a percentage point, bringing the target range for the federal funds rate from 0.75% to 1%. Year-round rates to alleviate inflation, which have been pushed up by supply chain disruptions caused by COVID-related blockages in China and ongoing Russian attacks on Ukraine. Economic growth. According to the December 2021 forecast published in the Federal Open Market Committee meeting on December 15th, U.S. GDP growth is expected to grow further by up to 2% in 2024. At the meeting on March 16th, 2022, the Feds revised its previous projections, predicting a lower GDP increase of 2.8% in 2022, followed by a 2.2% increase in 2023 and a 2% increase in 2024. Unemployment. As of the same report, the Federal Reserve has estimated an unemployment rate of 3.5% for 2022. The rate is expected to maintain that level in 2023 and reach 3.6% in 2024. The rate peaked at 14.8% in April 2020 as workers were laid off from work in response to the pandemic. Jobs. The Bureau of Labor Statistics publishes an occupational outlook each year that delves into each sector and occupation. Overall, the BLS predicts an increase in total employment of 11.9 million jobs between 2020 and 2030. Inflation. The core inflation rate is projected to be 4.1% in 2022, falling to 2.6% in 2023 and 2.3% in 2024. The Fed's target inflation rate is 2%. Core inflation, the Fed's preferred rate when setting monetary policy, eliminates volatility in gas and food prices. Interest rates. In March 2020, the FOMC held an emergency meeting to address the economic impact of the COVID-19 pandemic, lowering the federal funds rate from 0.7% and 0.25%. At the meeting on March 16, 2022, the FOMC announced it will raise interest rates for the first time since 2018 to counter the rise in inflation. The target range has been increased to 0.25%, from 0% to 0.25% to 0.25% to 50%. In its projections for March 2022, the FOMC has estimated a steady increase on the target Fed funds rate to 1.9% in 2022. The expected target rate will increase to 2.8% in 2023 and 2024. The Fed funds rate checks short-term interest rates. These include bank prime rates, most variable rate loans, and credit card rates. The Fed has worked to keep long-term rates low in an effort to make leading cheaper and in turn encourage consumer and business spending. It restarted its qualitative easing program and soon expanded its QE purchases to an unlimited amount. In March 2020, the Federal Reserve announced it would buy $500 billion in U.S. Treasuries and $200 billion in mortgage-backed securities as well. By June 2020, its balance sheet has grown to record $7.2 trillion. A year later, in June 2021, that figure had reached $8.1 trillion, and by December 2021, it reached nearly $9 trillion. By buying bank bonds, the Fed reduces supply in the Treasury market, delving up prices and lowering the yield of those long-term bonds. These yields are the benchmark for long-term fixed-rate mortgages and corporate bonds. Treasury yields also depend on dollar demand. High demand puts downward pressure on yields. Once the global economy recovers, investors could demand less of this ultra-safe investment, driving up yields and interest rates. Oil and gas prices. The energy outlook of the EIA until 2050 foresees an increase in oil prices. According to the data, the average price of Brent oil could rise to as high as $170 per barrel in 2050 in constant 2021 dollars. This forecast does not take into account the government's efforts to increase renewable energy production in an attempt to stop global warming. Climate change. The Federal Reserve is concerned about how climate change will affect the economy. Research from the Richmond Fed estimates that the company continues to produce emissions at a high rate. Climate change could reduce the annual GDP growth to 1/3 of its historical average. In 2020, the United States suffered damages from both hurricanes and fires, as in previous years. Global damage caused by natural disasters associated with climate change, such as hurricanes, floods, and forest fires, were $210 billion in 2020, a significant increase from $166 billion in 2019. From insurance amounted to $82 billion in 2020 and $57 billion in 2019. Damage claims got worse and worse and more frequent due to global warming. There were 980 natural disasters in 2020, up from 860 in 2019. The U.S. economy is a mixed economy. The U.S. government encourages free market activity but occasionally intervenes in the market, as with the Federal Reserve's quantitative easing programs. How much money is in the U.S. economy? Money can refer to dollars in circulation or credit in the economy, but the GDP can be easily measured in exact dollar figures. In recent years, the US GDP has surpassed $21 trillion, plus a decline during the start of COVID-19 in 2020. Tell us in the comments section your view on the topic. That's all for today's video. If you like our content, consider subscribing to the channel by clicking the subscribe button down below. Thanks for watching.